Has not been a good year so far for electric vehicles, with car rental companies phasing them out, shedding their fleets, and automakers slashing production. This morning, Morgan Stanley analyst Adam Jonas, remember the Jonas Brothers, by the way, said each day brings increasing signs of slowing global EV demand. And this could potentially get worse with another Trump presidency and the end of tax credits for those EVs. Our next guest just downgraded Hertz from a buy to a hold and says the EV problems aren't going to go away overnight, despite what Hertz has done. Stephanie Moore is equity research analyst at Jefferies. Stephanie, welcome. I love it when an analyst puts a stake in the ground, as you just have. I mean, you have cut the estimates on EBITDA by 40% next year to $500 million, lower than the consensus by more than $300 million. What's wrong here with Hertz?
No, absolutely. And thank you for having me. No, I mean, what we're seeing right now, it's really two factors that are coming into play. The first is that used vehicle values, particularly EVs, as you have noted, have decreased pretty materially on the EV side, but also broadly across the board. And that's certainly having a pressure on car rental stocks, but mostly Hertz, as you noted. The second issue is actually very unique to Hertz in that they are seeing elevated EV costs from higher damages and repairs related to these EVs. And these are higher damages and repair claims versus even, internal combustion engine vehicles. This is creating a lot of just lack of visibility into when these issues are going to actually subside over time. So while you noted we did cut our estimates to about $500 million in EBITDA for 2024, well below the street, which is at just over $815 million, we don't even have a lot of visibility and faith in even these cut numbers.
Is Hertz going to what they're doing? I think, if I'm not sure I've got the percentage right, but it's about a third of their EV fleet is what they're getting rid of. Is that right, or am I right on that?
Exactly. So they announced about 2 weeks ago that they were rebalancing their portfolio, and they were going where they will be selling 20,000 of their current 60,000 vehicles, which are EVs in the U.S. Look, I do believe that this is the right move, just given the cost headwinds that we have seen across EVs. But, look, to your point, they're only cutting about a third of their current fleet, and they'll go so that by the end of 2024, EVs will make up about 8% of their fleet. It had been about 10%, but note that, a year ago, Hertz was targeting that EVs would make up 25% of their fleet by the end of 2024.
They were pushing it. They were pushing it hard. Do you think they're going to get out of it? And will other rental car companies, now Hertz owns several brands, including Hertz, but will they follow suit here to the extent that they're in the EV world? And is Hertz going to get completely out of it?
Well, so, Hertz was really at the forefront of EV adoption. They first started their kind of foray into EVs with some partnerships announced back in 2021. And the other EV companies really have not followed suit to the same magnitude of which that Hertz has. So I would expect to see that Hertz is going to be the one with the lion's share of the impact of selling EVs and kind of pausing this strategy, just given what we're seeing today. And what we're seeing it's a couple of factors. So, the original adoption that Hertz expected from EVs has not panned out the way they expected. You just have not seen the penetration, the demand from customers, all of which is coming into play where you're just not seeing the same, the adoption that they wanted. And then the other side of it is that you're seeing higher repair costs because, honestly, it's a little bit of a different vehicle to drive.
Well, it is a different view. That's what I want to get at. As I give background here, you have your base case is an $8 a share stock, which is a little bit lower than where it is now. Best is $12 a share, and downside is $3 a share on Hertz. That's pretty amazing. I wonder why they're having such higher, not repair costs, I guess I get that, but collision costs and so forth. Is that because people just are not familiar with driving those EVs, and so they're distracted by the touchscreen, or what it is? Do you have any hunch?
Well, I don't know, Tyler, if you've ever driven a Tesla, but the first time I got into it, I was pretty surprised by how little you had to really press down on that gas pedal, and you really don't touch the brake at all. So I think just the aspect of the amount of torque when you are driving an EV, it's just a little bit different, a little bit more sensitive. And I think you're just seeing, particularly in their rental fleet, not in their ride share, but in their consumer rental fleet, they are seeing a higher degree of accidents. And then you take this a step further, and accidents are one thing, but the majority of their EV fleet, it is Teslas. So what you're seeing is that Tesla does not have necessarily the repair the repair infrastructure than other OEMs. So you're also facing higher repair costs dealing with parts as well as actual labor related to the vehicles themselves.